I think everybody heard that message, so I want to welcome you again to the fourth in our series of 8 webinars that we're doing this early part of 2010 on succession planning and various issues related to that. The program, my name is Chris Cooper. I work at the Business Succession Planning Program based in the Ohio Employee Ownership Center at Kent State University. The program is being funded by the Ohio Department of Development, so we thank them for their support. And today's speaker, we have Dave Gustafson from Apple Growth Partners. Today's topic that Dave's going to be talking on is selling to managers and key employees. And it's a very important topic. It's one of those ones that there's a market, there might be a market out there for you to sell your business to some key employees and managers when you're starting to think about succession, and Dave's going to be talking about that. So I think at this point I'll go ahead and turn it over.
Okay, and again, I'm Dave Gustafson with Apple Growth Partners. Welcome. I guess let's get right to it. And I guess if you'll click ahead, Chris, start clicking ahead. I'll start with the typical boring IRS bureaucratic tax notice that since I'm not addressing questions for your specific facts, you can't use this for filing tax returns. And now let's get down to business. Now, continuing on. Oh, I can do this. All right. Let's see, starting with, okay, let's talk a little bit about what we are going to talk about. First of all, talk about advantages and disadvantages of selling to your employees, why you do this versus some other succession planning alternatives. We will spend a lot of time focusing on key issues that you will need to address as you go through, think about a sale, and that you will want to make sure you cover as you're going through that sale. We will also talk a little about some value considerations, talk about value of the business ever so briefly. When and where it's important will be key to this particular discussion topic more than any other. I'll talk about a few valuation, I'll call it myths and legends, and then some valuation issues that you may take advantage of as you're planning through this. We'll then go through and look at some tactics or some strategies. I have a couple of examples of a few things in here and put some actual numbers on some things to give you an idea of what it might look like if you're going to do, for example, a seller note or some things like that. And then finally, the last thing we'll have are what I will call a whole bunch of ancillary issues, practical tips, planning tips, things that most people don't think about when we're starting here, and we at least want to get it on your radar. If you're planning to go down this road, here are a whole bunch of things that you'd want to think about as you go down the road. For example, if you are winding up selling to your employees, your buy-sell agreement is going to be hugely critical. If I don't mention it at the end of 10 times during this session, I probably will not have said it often enough about how important a good buy-sell agreement is as you're going through a succession selling to your key managers or employees. And I'll invite Chris to harass me at the end if I haven't said it that often to remind you again just how important it is to have the buy-sell agreement once you've started down this road and to get it on board. Advantages. Probably the biggest advantage to selling to your employees is what I would call confidentiality, and that is, I guess I'll contrast that with if you're looking to sell your business to a third party, you hire a broker sometimes, most of the time, you'll wind up having 4, 5, 6 people, competitors, strategic partners come in. Everybody comes in and really kicks the tires and looks at you, and unfortunately you're then showing your business trade secret to your employees, to your competitors. Selling to your employees is you and the key employees working something out, so it is much more confidential for the business. It is at least a good possibility that this can provide the kind of incentive that will retain and motivate key employees. If you have key employees, obviously making them owners gives them a stake, it gives them a better reason to stick around. Reverse of that is also true in that if you're getting to be 60 or 65 years old and your key employees see no succession plan in place, they might start to worry about what's going to happen or what's going to happen if we sell the company to a third party, or what's going to happen to my job if the person wants to retire. And therefore, this will provide some definition to that and eliminate that uncertainty. another big benefit is, by and large, you will be able to continue and retain most of the benefits of ownership during a transition, i.e., while you're selling to your employees, if you're still the key owner, you're certainly still keeping your health care, which is usually hugely critical to getting people to Medicare so that there's not a health care void while you're doing succession. And obviously, if you're still employed doing this in an orderly fashion, you're still on the health care plan. Lots of your perks, a club, any other perks you may have, probably get to stay in place while you're doing this, certainly more so than if you're sold to a third party. And actually, it may also provide the optimal payout over time. When you add everything up, selling to your employees, if you're a smaller business, probably, or may wind up being the best total return. You're keeping some of the risk of the business going along, but you can also get paid for that risk. And what I mean by that is, the easiest example is a professional practice. You get to keep practicing and, keep your clients and keep billing them and keep your draw and keep your, you also get to keep the annual earnings of the business while you're doing this by and large. And again, then you'll also get an eventual payout. When you do sell it for a note, you'll get, hopefully get the note paid off plus interest. And when you add, your ongoing compensation and things like that you will continue and you can work sort of as long as you want. You sell to a third party, that's a more interesting discussion of how you want to work and when you work and working on their terms versus, orchestrating something that's more on your terms over the transition period. Realistically, there are a couple reasons people sell to key managers or employees. Probably one of the bigger ones is its practical consideration. Based on the size of the company, if you're in a company of 15 or 20 employees or less, you really have sort of two choices to sell. You can sell to or maybe three. You can sell to your employees who know the business. You can sell to a competitor who's going to do whatever they want with your business. Or you can try and go out and find like an owner-operator, somebody that looks like you that wants to come in and buy the business. And it's generally going to be somebody that works in the business. With businesses with less than 15 employees, generally there's not a third party. It's not an outside investor. It's someone that is, that's somebody going to live and work in the business and contribute to the business. So you've got those parameters of who the possible buyers are. And the last way you wind up doing this is wind up just being the evolution of the firm or the company. As you grow the company from 5 employees to 10, you wind up with a couple of key folks along the way. As they build their practices or they help become more key people, they just wind up wanting a piece of the equity. And if they have a piece of the equity as they've grown into the business, they become an easy, more likely buyer, and it's just sort of a natural evolution. Okay. Biggest disadvantages is where's the money going to come from? The hardest part here is very few of your managers, key people, have money. It's not like they have a check that they can go write. And so it does mean that this is going to be more a high risk for the payout because the money to buy the business is going to come from the business, whether it's future earnings, whether it's current earnings while you're transitioning ownership to them. But in one way or another, the business is going to buy the business, and therefore that's where the money is going to come from. Second disadvantage is really the time required for this, because as you're going to see from some of our examples, this is not something you're going to do in a couple of years. This is something that should take multiple years, between planning it, between maybe getting some people some stock up front, and or I'll have an example later where even if you did it just for a note and are willing to carry the note, the time it takes to pay off a note to buy a business at reasonable multiples of earnings is going to be a very long period. So you're going to wind up carrying paper for a long time at the very least. And so between the funding and maybe taxes that are along the way, by the way, then throw in training or grooming your successor managers so that they're capable of running the business. All of those things definitely require significant time. It's not something you wind up, I want to retire 6 months from now, let's do this now. That's going to be a challenge to make happen. So you really need to plan ahead, set up a design, get this going. Okay, let's work through some of the key issues. again, back to the number one hurdle is how do you fund this? Most managers do not have money. If they do, great. So you're going to start looking at the funding sources of this. And each of them have advantages and disadvantages. First of all, if you're making cash bonuses to your key employees as you go now, certainly you can start, if this is something you want to have happen in 5 years, you probably want to be having discussions that they should be making, they should be saving this, they should be putting it away if they want to buy the business, and you can start walking through making sure they're doing that. Now, that's easier said than done, because lots of times, you can pay cash bonuses and either they or their spouses have a habit of using those funds for other alternatives. The other risk in doing this with cash bonuses as you go is, let's say you have a 5-year plan that you want to sell out in 5 years. If one of your key people gets divorced in year 4, you're in a bad place all of a sudden, because all that money that was saved up is going to wind up being fought over in a divorce and not be necessarily available for what you want it for. Lots of times we see stock bonuses or people being awarded restricted stock as a key way of doing this. And in this case, you are physically granting your key employees a number of shares in the company as an annual bonus. And if you can do it, instead of a cash bonus, you wind up giving a person 5% of the company at the end of the year as their bonus instead of cash. By the way, if they or their spouse are used to having that kind of a cash income stream, that may not be viewed too favorably, even though it's it's in their long-term best interest because they'll own the company. But if they've gotten used to a given lifestyle based on a given income stream, this is not necessarily going to be viewed completely favorably, and so it requires some discussion. This is where you'll absolutely have to have your buy-sell agreement in place, because you want to have absolute control over how things go once you start giving other people stock in your company. You're going to wind up diluting your interest, as obviously if someone else gets 5% or 10% or 15 or 25% of the company over a 5-year period, you've gone from 100% down to 75%. Hopefully growing the business somewhat to offset that, but again, you're diluting yourself down by doing that. A couple of things as you think about it. The reason I say this as restricted stock or buy-sell agreement, when you do this, you'll give the people shares, but you're probably going to have in your buy-sell agreement provisions that sort of say, if you leave and go to a competitor, we buy you back for virtually no money for these shares. Maybe if you leave and go somewhere else, you don't get anywhere near the good payout you would, versus if you reach if you reach full retirement or if the company's sold, then the payout is a much bigger number. Basically what you're trying to do is draft stock restrictions that favor this going towards the eventual they buy you out of the company, so that it's very unfavorable for them to leave without buying you out, but that when you hit normal retirement age, the buy-sell agreement sort of trips that they're buying you out at a good price that's sort of upfront negotiated. Next issue. Part 2 of this for me is management succession. And that's that, yes, we can talk about how to get shares in people's hands, but ownership succession is only half the battle. A company needs a strong management team to succeed. Realistically, would you invest in a company that had a lousy management team? And so as you're thinking about the ownership side, you need to think about the management succession side. Next. Hey, Chris, can I control these? I was earlier. With management succession, we are looking at what skills does the owner have, because obviously, if you're the owner of a small private business, you usually got there because you are a key person at the company in your own right. You are key to getting it going. So generally you have more hats than anybody else in the business. And the thing here is, how do you replace those hats, and also when do you replace those hats? Are you key to sales? Are you key to customer relationships? Are you the key technical person, key financial person? What of those skills need to be replaced and when? You really have to start working on the management side of this. And maybe in the next piece, a couple of other skills that maybe not so obvious. Next slide. Management issues, leadership of the company. You may have a very good technical resource that can replace your technical skills, but everybody comes to you for leadership. How are you grooming your successor for leadership? The last two are even more fun because these are personality traits. You know, are your next generation owners good entrepreneurs? Are they going to do they have the stomach and the spirit to take good business risks? That's an interesting question. And do they have an ownership mentality? At the end of the month or every 2 weeks when payroll comes, do they know, by the way, I got to make sure we have money for payroll? And so you not only have the technical skills, you have the leadership skills and the entrepreneurial skills. All of those things are, skills that are required. A fun example I had, and it wasn't a management succession, but when we had one of our companies selling to an ESOP, I had the primary owner. His number one issue was he was worried his managers would be too conservative because he was the ultimate risk taker in what was a very big firm, actually. His managers were very good operations people, but we spent a good year as part of coaching the managers, getting them to think, how would your predecessor have handled this, and what kind of risks should you be taking so that the company doesn't stagnate, and it takes all the proper risks you actually want it to take. Next issue to think about is, who are the key managers? Who are you actually going to pick to sell the business to? It comes down to who has the skills, who has the leadership skills, who has the abilities and that to make the money. You're going to look at this from a couple of standpoints. One, what's in the best interest of the company? Who's going to keep this company healthy for the next generation? And it may not be the most technical person. It may not be your best technical resource, or it may not be your finance person. It may be, somebody else who has more leadership base. But you have to look at who's going to be in the best interest of the company. Probably a little more selfishly, if you're the selling owner, who's going to write the checks and who's going to run the company so the company can write checks to pay me out in my retirement? You really do got to look at, you want to get paid, you've got to make sure the people are there that you're picking that are the successors are the ones that will be able to pay you. Some age demographics may play in this as well. If you're retiring at 65 and your successor is 60 and they're going to have to write checks to you for the next 6 or 7 years, they may want to retire before the bill's paid. You may have an interesting age or demographic issue there in who you're picking as the buyer based on who's going to be, who's going to want to pay you for 5 years and then own the business after that, and how long will they get to own it. This is one where I have a plan in process right now, a planning client, and we've been going through this very exercise, and he picked 3 people, and one of them is his successor president. He's the exact right person to pick. The other 2 people were his brother-in-law and another key manager who's a year older than him, and what they are is very good long-term employees that helped him build the business. But I looked at him and said, these people are both a year older than you. How are they going to help buy you out when you want to retire? And obviously I got a very funny look from them because they're not. And therefore you have to look at who is going to buy you out that's going to be able to write the checks to buy you out, not who you're going to award stock to as a nice gesture or a good gesture, who's cashing out before you are. And then one more key issue I want to talk about is, don't forget about strategic planning in this process. You have to make all of your planning for succession and for this transaction should be done in the context of what is the strategic for the business and for the owner. So this has to be done in concert with your strategic plan. Don't lose sight of, this is part of the overall plan, and the company's success is critical to your success in being bought out. So this is part of your overall succession plan. Now let's start talking about valuation consideration. Everybody wants to talk about the value of their business. So let's talk about it from a couple of definition standpoints. Everybody's used to talking about what, fair market value, what you could sell it for, and there's a technical definition we get from the IRS, willing buyer, willing seller, and what they would expect to sell the business for. I'm going to politely say, by the way, the fair market value standard assumes a cash or cash equivalent purchase price. That's not necessarily relevant here because none of your buyers probably bring cash to the table. They have no cash. They're either going to get stock with a note or something else. So yes, a third party might write you a check for $1 million or $2 million for your business, but if you're the buyer of that business and you bring no cash to the table, it's awfully hard to say that, well, third party sale for cash would spend $1 million. You can only charge us $1 million. And it's like, well, yeah, but you bring me $1 million cash and we'll have that consideration. If I'm carrying the paper for the next 5 years, that's not necessarily the relevant value standard. Something else I want you to think about if you hear people talk about their businesses being sold is what's the definition, is what are they really talking about in the next slide. And what I mean by that is people will talk about either the assets that they are sold, and I'll give you an example. If, for example, someone tells you they sold their business for $5 million, most people's knee-jerk reaction is sort of on the slide here, there's a column that says expect. We sold the business for $5 million. Okay, we paid a broker a commission of some amount, but we still have most of that $5 million. And then yet, as a net available, we do probably have some sort of capital gains tax issue, but we wind up with a significant part of that as the owner proceeds that we can actually spend at the end of the day after paying tax. Well, what most brokers will talk about is what's called total invested capital when they quote you the sale price they're talking about, which is the value of the equity as well as the value of the total debt that the company has. And so, for example, if you do a stock sale, that's going to look a lot like your expected sale in that if you sell your stock of your company for $5 million, the broker is probably going to charge you a commission on the value of the stock that you sell plus the value of the underlying debt. They call it total invested capital. So you probably wind up with a little higher broker commission, but you're still, if you're doing a stock sale, going to wind up with, the only major item in there as the capital gains tax. On the other hand, most businesses are sold in what are called asset sales, which is you sell the assets of the business, not the stock of the business to the buyer. And that's a different perspective because when you're doing a stock sale, and a C Corp is worse than an S Corp, as you'll see in my example, but I'll take the worst case example. The broker says they're going to sell your business for $5 million in an asset sale. They take their commission, but then they expect you to pay off the bank debt, if you will. And if you have $2 million of bank debt, before you see proceeds, you have to pay the bank off, which is maybe, as I said, a $2 million obligation. You also have, this is a sale at the corporate level, and if you're a C Corp, you may have a corporate capital gain on that transaction, which may mean the corporation sends money to Uncle Sam even before it can distribute money to its shareholders. So by the time you're done paying the corporate income tax on a C Corporation sale and paying off the bank debt from the total invested capital price, you may only wind up with, let's say, maybe $1,750,000 out of what you heard was a $5 million purchase price. Takeaway from this is make sure you understand when someone's talking about price, are they talking about a stock sale or an asset sale? Are they talking about a total invested capital value, or are they talking about an equity value? Because obviously shareholder equity is something that's a lot easier to spend. Total invested capital means you have to settle up with the bank or any corporate taxes or anything before you see proceeds. So when you're thinking about a third-party sale, if somebody gives you a bigger number for a third-party sale, make sure it's apples to apples. There really is no formal valuation standard for an arm's length sale. What I mean by that is if you negotiate a price with your employees that the value of the company is X and sell it for that, the IRS is 99.9% not going to challenge that really is the fair market value because you don't normally have any donative intent, or you're not really going to give it to the employees normally, so they're not going to assume that you did that, and whatever you negotiate is probably going to be okay. One place that will come into play is if you're making if you're actually making the stock bonuses or giving restricted stock to people, that's compensation expense, and you will have to have some kind of fair market value determination for that. Next slide, value considerations. My next question is, when is value even relevant to you if you're thinking about doing this? If you're thinking about wanting to retire 5 years from now, and that's when you're going to get most of your money, that's when the value is relevant. I'll come back to an example I have right now where we are trying to get one of our owners to give some stock to 2 or 3 40-year-old key managers so that they eventually will buy him out. And 2 years ago, his business was worth $2 million. Well, with the recession in between 08 and 09, went back and ran some of my models this year, and probably he's only worth $1.5 million now. And yet he wants to award the stock based on a $2 million value, and I look at him and go, why? One, you know, it's not really important. One, it's not probably the real value anymore. But you're giving people stock. You're not getting any cash out of this now. So why is the value of the business even relevant right now? It's relevant when you want to sell, when people start writing you checks. That's what you need to focus on, and is the important thing for value, is when you're getting checks. In fact, quite frankly, the reverse is the case with respect to discounts, because if you're awarding your employees a stock bonus of 5% of the company, that's not necessary. If you're a $2 million value business and you give an employee 5% of your company, that's not necessarily $100,000 worth of stock to them, because it's a minority interest, which is as valuable as a controlling interest. It has no market whatsoever, and in fact, by the time you put your buy-sell agreement in place, it's going to be next to impossible to sell, so you really do have a lack of marketability. And by the way, that's intentional. So maybe instead of awarding them the stock at $100,000, what you'll wind up doing is saying that stock's worth $65,000, and their compensation bonus that they have to pay income tax on that year is only $65,000, not the $100,000. And by the way, since they're paying income tax on that, you know, the lower number may actually be the right answer, or may be helpful, because you don't have to gross up as much. And I'll give you an example of grossing it up in a minute. So this is where you can actually use discounts to your advantage of give people sort of cheap stock. They'll see it as an extra incentive because you actually gave them $100,000 of stock eventually, but their income tax only saw $65,000 of income. And by the way, it's only worth $100,000 to them if they go forward with the plan and buy you out. So you're setting up incentives, again, to make this work to your benefit, and using value discounts maybe to take advantage of that. Realistically, how you're going to come up with the value when it comes time to pull the trigger are going to be a couple of factors, all relevant. And fair market value may or may not be a consideration of this. First of all, the first consideration is for what the price will be, is what are the ongoing cash flow needs of the seller. You know, if a business is worth $2 million but the owner needs $3 million to retire, you're not going to have a transaction. You know, so you do have to look at the ongoing needs of the owner, between the purchase price, between a deferred comp, between medical, between perks, on, you know, any kind of ongoing compensation. You need to see that however this transaction is structured winds up meeting the cash needs of the seller. That's going to be consideration one, because if you don't meet those, you don't have a transaction. Number two is it has to be within, this may be a lower indicator of value, you're going to have to structure a transaction within the cash generating capabilities of the business. If the business can only generate so much cash, that's kind of as much value as you can say the business has. You can't really, business that generates $500,000 of cash a year really can't afford to pay a $600,000 note payment every year. It's just not going to happen. So you've got the owner's needs for one, but wishes for the other, and then the business's cash generating capability are kind of the outside parameters of value that you're negotiating off of. And then at some point, consideration or perceptions of relative fairness. You know, when you're looking at if you're the buyer, you know, do I have to pay this for this business over the next 15 years? That's just too long. That's crazy. It has to be done over a rational period of time, and it has to be perceived as fair to buyer and seller. And so that's going to be sort of the balancing act between number 1 and number 2, and that's more realistically how you're going to come up with a number of, what kind of business can the cash generate, what kind of cash do you need to retire, and if or what do you want if you retire if the cash generating business capability of the business is above your needs. So those are the things that are really going to help you determine what the purchase price is. Okay, let me work through a couple of, if you can go to the Excel spreadsheet now, Chris, let's work through a couple of examples. And the first one is going to be just why you need to start early. Okay, let's work through a quick example here of a business that makes $500,000 of earnings before interest and taxes, what we all call EBIT. And if you're a 50-employee company making, good money, a 5 multiple is not all that expensive. If you're a 10-person company, 5 is probably expensive. You're probably going to deal with some kind of, 2, 3, 4 times seller's discretionary cash flow, not what my example is here. But I really wanted to make an example for the business that is, sort of an operating company that, multiples of 5 times EBIT. When you take that multiple and look at, okay, on day 1, I am the seller, and I'm going to take a $2.5 million note for that. Well, how fast can we pay that note off? And if you look at my spreadsheet here, it's going to take 10 years to pay that note off with every dime that the company makes for profit. The company makes $500,000 a year in profit. First of all, it's going to have interest expense on the $2.5 million note. I've set it at a relatively modest 5% here because if I put it at 7, 8, or 9, it's more than 10 years to pay this note off. But the company can deduct interest expense, so then your pre-tax income is $375,000. You're going to have some, whether you're an S or a C, somehow, some way, there's going to be some income tax on the company net income, and I've got it at a 40% tax rate at $150,000. So that's going to leave after-tax net income of $225,000 that you then can pay to the seller to pay off some of the principal balance of their note. So between the $225 after-tax income and the $125 interest, my seller in this example gets about $350,000 of seller proceeds in year 1. Now, recognize that the interest is taxable to the seller as ordinary income at 40% probably. The capital gain may be at a lower rate. Capital gains rates are still lower, knock on wood, depending on what happens over the next couple of years. So my $225, if the owner has no basis in the business, i.e. they started it from scratch, it's been a C Corp, they don't have, their basis is 0, they're going to pay tax on that $225 at least a 20% combined rate. And so their proceeds after tax are only about $255,000. And you'll notice you model this out over the 10 years, that's pretty consistent. The seller winds up, there's $500,000 of cash being generated, but when all is said and done, the owner's only walking away with about $250 after tax after the government. Something I'll mention later, you need to know your basis in the business, in the stock that you're selling as you're selling to your employees. If you have basis, if you've been an S Corp, if you have $2.5 million of basis, then clearly you're not going to have capital gain on the after tax, on the principal part of this loan, and it changes this equation dramatically. But back to my point, if you wait till the last hour to do this, and then even if you're willing to sell your company to your employees on a note, you could wind up doing this 8, 9, 10 years. And I don't know how, if you go to your managers and say, geez, you can give us all your profit for the next 10 years, how excited they're going to be about that prospect. And so that it really does say start early on doing some planning. The second sheet of this example is, let's say we can do this with a deferred comp arrangement. I'm going to let Uncle Sam, I'm going to work on my some tax benefit. I've done this as an extreme opposite. The other thing you can do is create a deferred comp plan for the business. And what I mean by that is the company agrees to pay the owner, who is the key employee at the company, maybe $500,000 a year for up to, let's say in my example here, for 10 years after they retire. And you normally wouldn't do the entire payout as a deferred comp, but I wanted to, the example works better for how the tax benefits play if I do it exactly like my last example. So basically what would happen there is if I have an obligation to my president to pay him or her $500,000 a year for the next years, that's probably going to wipe out all my $2.5 million of value. So my value in my example here is 0. You almost transfer it to the buyer for $1, and then the company makes a $500,000 deferred comp payment to the owner each year for the next 10 years. And what's important about that is, you see the company makes EBIT of $500,000. It makes a tax-deductible payment to the owner, and therefore it has no corporate income tax. And therefore it also has no after-tax income, by the way. But then the seller proceeds are $500,000 a year. Generally speaking, the deferred comp plan is ordinary income to the seller, so you have your 40% tax rate there. And in this example, then, your seller winds up with $300,000 of proceeds. What's important about this is, you noted my last example, if we do this, this is the exact same payout. It's $500,000 a year company money, and it's all going to the owner, basically. But if you note in my example here, the owner gets $300,000 a year. In the prior example, they only got about $250,000 a year. And what you were working on with that is, the prior example had both a corporate tax as you were making the money at the corporate level, but the owner, if they had no basis, had a capital gains tax on the proceeds, and therefore the double taxation sort of on the note version tended to reduce the proceeds. If you were really doing this, odds are the owner has some basis, or you might only do some kind of deferred comp plan for 1/3 of the purchase price, for half of the purchase price. You really wouldn't do it for the whole one, but you note, because you get out of there's only one layer of gain paid here, you may wind up with better proceeds to your seller by implementing a deferred comp plan as part of this. Now, if you can go back to the note version of this, Chris, I'll show you one sort of odd example. And Chris, change the capital gains rate to 0. Here is my example of, if you have full basis for your stock, or if for some reason this transaction is not taxable on a capital gain basis, you get the exact transaction that you do with the deferred comp, and you don't bother with a deferred comp at all. The reason the deferred comp helps is if you have some taxable gain on this transaction to the seller, a deferred comp can eliminate that layer of gain. If there is no capital gains rates because you have basis or some other reason, then there'd be no reason in the world to do it as a deferred comp. Just do it as a note. And clearly you see now with a 0 tax rate, the seller's net here is $300,000, exactly like my deferred comp example. So deferred comp can be a way to save some taxes in your planning process, and these sort of give you an example, one, of how long it takes if you wait till the last minute, but also, think about, does a deferred comp plan help you, because it might for tax reasons. The third spreadsheet I have here to look at is give you something to work on with respect to, let's say you want to do some kind of stock bonus award to your employees for 5 years before you would pull the trigger. It does a couple of things. One, obviously, then they're going to own 25% of the business, and you're only going to have to buy out 75% when they pull the trigger and with a note or something else. But let's walk through what the practical implications of giving someone a stock bonus are for that 5-year period. Again, my company is worth $2.5 million and doesn't necessarily change, but you're going to give them a stock grant of 5%. However, remember, this is restricted stock. It's a minority interest. It's not marketable, so it probably has a discount for lack of marketability and minority interest, and I've got in here a 35% assumed discount. So instead of this being a $125,000 award or compensation to them, you're probably going to put on their W-2 and in their income only $81,000 of value, because it's a restricted stock, it's not marketable, it's a discounted price. So you're in giving them 5% of the company, you're actually only going to show up as $81,000 of compensation expense. Now, you have to gross that up probably, and here's what, for those of you that don't do this all the time, if you award someone $81,000 of stock, they're going to get a W-2 at the end of the year for that $81,000 in addition to their regular compensation. They have no money to pay their income tax on for that, and that's not going to fly. So you're going to have to do a circular calculation of how much of a cash bonus do I have to award them above and beyond that, so that when they're paying their taxes, they have enough cash to pay their taxes on both the cash that we have to give them as a bonus and the stock that we have to give them as a bonus. And both of those bonuses are tax deductible to the company, but therefore you sort of have to gross it up. And this will depend on their individual tax rate, but if you're giving someone $100,000 of income, they're probably going to be in high tax brackets after they have their ordinary income. So you're probably going to have to gross it up at a 40% rate. You take the $81,000, you can do that, divide the $81,250 by 60%, and it'll say their total gross up has to be $135,000. And if you subtract the $81,000 from that, you have to write them a check for $54,000, and you might even just send it as withholding to the IRS and not even give it to them. But that way they'll have money to pay their tax. Otherwise, you've given them a tax obligation that they just can't deal with, and so you have to think about that as you're doing stock bonus. By the way, a hidden value here is you've given them $81,250 of income each of these 5 years. That didn't cost you a dime. That didn't cost you any cash whatsoever for that part of it. So you've taken a tax deduction for this $81,000 that you've given them in stock. So you probably should have $81,000 of extra cash at the end of the year. Now, whether you save that cash to help fund a deferred comp, whether you take it as a distribution or something as the owner, there's going to be $81,250 each year here that you're giving them a stock bonus, because that's paper, that's not cash. So you're going to have some money accumulating, or you're going to have some money you can pay yourself out as an S distribution or something to get a little bit of benefit out of this while you're doing it. Now, go back, Chris, if you can go back to my first purchase price note calculation. The other reason we talk about doing this is obviously if you give them 25% of the company in the 5 years prior to this, then if the company's still only worth $2.5 million, your note's going to be for about $1.8 million or $1.9 million. And if you look at the example, count 1, 2, 3, 4 years out, you have probably shortened your note to a 6-year note or 6.5-year note from the 10-year note that it otherwise would be by doing these upfront awards to people. Hopefully, by the way, you're growing the business in the meantime, and you do have a bigger number later. But in any event, this is how you chip away at the note at the end, and doing this up front, get your employees on board. They know they have stock. They're sort of committed to the cause because now they are the successor and they know it. But it has shortened that note, so you don't have to stick around for 10 years afterwards to make sure that you get your note paid off. Back to the PowerPoint presentation, and let's talk some practical considerations. I have about 10 minutes left from our time today. First, let's go for the... First practical is, again, we talked a little bit about sort of the ongoing, next one. First practical consideration, if you're going to have a promissory note, you're going to have a whole bunch of conditions and covenants and the like. What security is the company or the buyer going to give you for that? What operational control are you, you don't technically own the company after you've gotten this note from the company or from the buyer to buy your stock. But you have a contract, and in that contract it's going to say, I'm going to retain operational control till I sort of get paid for a lot of this. You're going to have to negotiate that. What operational control and when does it transfer? What financial covenants are you going to put in there? How much compensation can your buyer take till they've paid you off? Do you want to have life insurance on your successors? Because if something bad happens 5 years into the 10, their families are going to want something, but you're also going to want to get paid, and then so you might want some life insurance considerations there. You're certainly going to want them to have non-compete provisions, because if the business drops in value, you don't want them just to walk away from the note and leave you holding the bag and go out and compete with somebody else. So you're going to look at all sorts of provisions, and my takeaway from this is if you think the bank has onerous provisions, yours as the seller are going to be considerably more onerous on this note, because this is the whole value, lots of times a much higher percentage than the bank's willing to lend, so you're your security and your provisions are likely to be much more detailed in your promissory note. By the way, you're going to have similar issues with the deferred comp because you're going to want to get paid to the deferred comp. It's harder to put the operational control and some of those issues in a deferred comp because it really is just an obligation of the company. And so it's probably not what you can do as easily, but if you have a big part of your thing coming out as deferred comp, you're going to want to figure out how, conditions to make sure you get paid that. Other things that are related. What are you doing with the building? If you also own the building and it's outside the company, you may want to set up a very long-term lease so that you keep getting your rent from this as you go forward, and don't let them move 3 years into, 3 years afterwards and leave you holding a building. Or you want to make provisions that, okay, we're 5 years into this and you've almost paid off my first note, then you got to buy the building. And so you make sure that, buildings tend to be a big part of value. And if you own the building, you're going to want to make sure you make provisions either for leases or for the transition of the building. Probably with one of the big things we look at is what kind of medical insurance, not only for an owner but an owner's spouse. How do we get those folks to their Medicare eligibility? If you're retiring at age 60, we've got at least 5 or more years before you're going to be eligible for Medicare. How do we get you to stay on health care? Because, if you get $2 million for your company and then have a bad medical instance and you don't have coverage, your very well planned out succession just went up in smoke. So we do lots of planning on how do we keep people on the business's insurance coverage till both spouses are eligible for Medicare, if at all possible. By the way, I noted a lot of our folks on the session today are under 25 employees. Lots of times we might just take you up to age 63 and a half and then let you file for COBRA for companies that require COBRA coverage. But I think COBRA is only for companies of 25 employees or more. So if your business has 15 employees, you may not be able to get coverage under COBRA. You really have to plan it all the way until you're eligible, or make sure you've bought disability or some kind of insurance policy along the way. Another practical, who's going to take over the bank relationships? If you're guaranteeing any credit facility you have with the bank now, when, where, and how do your successors start guaranteeing the bank facility? And by the way, you're going to want to make sure the bank is comfortable that your successors are good people to lend money to, and you're going to, as part of the succession plan, for management succession, make sure the bank knows and the bank has confidence in them, because you're going to want to get off those loans, and or maybe you want the bank to loan them money so you can get a check from the bank instead of having to take a note from the business. But dealing with your bank relationship is another significant issue. As I said, generally this is a long-term process, and you got to pay really great attention to relationships. And what I mean by that is, you're about to transition all the relationships in your business, your customers, your bank. You got to work on the relationships with the key employees because they're going to write you some big checks. Or if you're the key employees, you want to have a good relationship with the seller because they're going to give you the opportunity to buy the company. And usually you have spouses that play in this. And so you've got lots of relationships that need to be paid attention to, because you've got people that have sort of forced relationships over a fair period of time as this succession takes place. So you got to pay attention to that. I mentioned it before and I'll mention it again. Let me repeat it. Your buy-sell agreement is critical once you start giving other people stock. And that buy-sell agreement has to support your long-term plan of they're buying you out, not you're buying them out at some point. Want to pay attention to income tax considerations. Back to my saying, you need to know your basis, and we'll try and make this as tax-free as possible, but there are taxes to be paid. Other practical considerations. Let's clean up your balance sheet. If you have personal items, you're getting to where you really are retiring and have a number of personal items in the office. I had a client that had a huge clock collection. They had 15 grandfather clocks in their office. Wanted to make darn sure all the employees knew those were not corporate assets, those were personal assets. And before anybody else got, a year or so before anybody else got to where they had big interests in the company as they were transitioning it, eventually he took the clocks home, so there was no question. You do sort of want to make sure everybody understands what's business asset and what's not. You'll also look at what you do with the income statement for the perks that you have. How long do you keep them? And it should be talked up front. By the way, if you've got key managers and you have a club membership so that you can wine and dine clients and prospects and things, they're probably going to want one sooner or later to be able to effectively do what you're doing. So you want to talk about all those things. With just a little bit of time left, I'm going to scan through a lot of these others. Obviously you're going to want to clean up your articles and regulations. Nothing worse than having a corporate record book that hasn't had shareholder minutes in 15 years if now you have 2 or 3 shareholders. You do have to get your house in order from a practical standpoint. I'm going to, at this point, we're sort of winding down. I want to make sure if there are any questions that feel free to grab them. And then I have a bunch of slides here, and Chris may put this up on the website. I'm going to scan through them quickly so everybody can see them. But it's getting your buy-sell agreement in place, whether it's an agreement that the company buys it back or a cross-purchase agreement that your other shareholders buy you back. And your buy-sell agreement has to provide for purchase price. You're going to want to talk about what the value is in your buy-sell. Who's going to buy? How they're going to buy? How they're going to fund it? What triggering events? I hate to say this, but you should have a death and disability provision. If one of your if anybody gets passes or whatever, you don't want to deal with in-laws and outlaws. You want to have a provision that says we will buy it back, and so you're going to want to have all those things worked out. And it really is important to go through and get a lot of these things in the buy-sell agreement. It is something you've got to spend a lot of time thinking about. The last couple minutes, I'll just spend a little time talking about the common pitfalls. First and foremost is people wait too long. You've seen that it takes a number of years to make this happen. I can't say I've ever seen it happen, but my worst case fear of an owner doing this is, okay, they decide they will happily, carry paper for their managers, and they reach age 65 and they go to their managers and they talk through this with them. And okay, you're going to buy my business for $2 million. I'm going to give you a note for 10 years to do that, and it's at a very reasonable interest rate. And at that point, one of the whether it's 1 or 2 managers, and by the way, then you have to take over the bank relationships and do all those things. What if one of the 2 just says no? They're not willing to take that risk. They're not willing to put themselves. Their spouse doesn't want to be put in that risk. You can't wait too long. You have to start early. You do have to have realistic expectations of value in terms of whether it'll support your lifestyle or not. You do want to get your management team in place. You've got to have good performance. You've got to have the talent ready to take over the business. And this comes down to you really do have to have maybe leaders ready to take over the business. And this is hard because a lot of companies have really strong leaders, and you wind up hiring people that help you, that don't challenge your leadership, that don't, that aren't monster leaders, and then all of a sudden you're going to ask them to be leaders. So you really do have to focus on making sure there's some people that will take over the leadership of the business. You want to revisit this. If this is a 5-year process, you don't do this once and hope it works and never visit again. Visit it after a year. Visit it after 2 years. Make sure you pick the right people to give the stock bonuses to, or you pick the right successors and they're growing as you should. Last but not least, common pitfall is many owners are reluctant to let go till the last minute. You've got to, if you're going to groom successor managers, you've got to give them some decisions and let them mess them up. They're going to make mistakes. You've got to give them a chance to make decisions, to learn how to be leaders and to be goers, and they're going to mess some of them up. You can't always make all the decisions and bail them out, because then they're never going to learn to make decisions, and you're not going to get paid. The last final words of wisdom with this are get started. Don't wait till the last minute. Set up your goals. Set up what you wanted. Do you want to be retired by 62? Do you want to be retired by 65? Would you like to work part-time as part of this strategy and make this a more long-term succession? But you've gotten rid of the day-to-day management headaches. Somebody else is the president, and you're doing what you love, and for the last 3 years that you're working, you're doing what's fun and letting them do the day-to-day and have all the hiring decisions and all the discipline decisions and all the dealing with the accounting statement headaches and all the HR headaches and the like. Set up your strategy up front and make sure the financial plans fit, and do some planning. It'll save you some taxes if you set it up ideally, but you got to get started. Questions, comments, thoughts as we come to the end of our hour?
Okay, Dave, I think what I'm going to do is I'm going to open up all the phone lines.
The conference has been unmuted.
We can hear everybody now, so I'm going to say, do we have questions?
It means you've either all fallen asleep or I've totally wowed you. Hopefully the latter.
Totally wowed us.
All right. Realistically, if you have questions, my contact data is at the beginning of this. Call me. I'll happily walk anybody through sort of this process and answer questions as we go. I know it's always a little awkward to ask questions with 15 other people listening. And by the way, my phone number, the office number is 440-460-1980.
Okay, great.
So, with that, I thank you for your attention, and as I said, invite follow-up and questions as you go.
What I'm going to do now is I'm going to turn off the recording. I want to thank everyone for coming to the session. I'm going to turn off the recording, and then I'm going to open up the floor one more time for questions for folks who want to ask them, if they want to ask some questions off the record.
Thank you. Please stand by.